All right, let's why don't we go ahead and get started? Oh, here we go. We got one more person coming in. Very exciting. Yeah. So hey everybody. My name is Rob Beardsley. For those that don't know, I'm the founder and principal of Lone Star Capital. Today we have Josh Hoffman with us, our asset manager. He'll be running the show. He's put together a great presentation and more importantly, he's on the front lines, really helping make sure that we're making things happen across the portfolio. So I'm really excited to hear his presentation, and of course we'll answer any questions during and at the end. So please feel free to make this interactive. So yeah, Josh, take it away.
Thank you very much, Rob. Yeah, I can't stress that enough either. If you have questions, feel free to just throw them out as we're going along. This is kind of more of just a free-flowing presentation showing you some tools that we use, both on the asset management and property management side. Our property manager uses this to look at leasehold data, leasing, application sales, leads, etc. But happy to share this and just an update about what happened last quarter and what we're looking forward to in this Q4. First off, just being that it is Veterans Day, just wanted to say if anybody is a veteran or have family members, thank you for your service. Thank them for their service as well. So over the last quarter, we did have quite a few changes, developments happening. Two of our most recent acquisitions, one is the Landing, the other is Solano. These are both in Texas. The Landing is in Lubbock, Solano's in Houston. At the Landing, we've had the majority of our CapEx work completed. So we do have two additional projects that are in progress. They're both exterior projects. We're converting an old rundown basketball court to a half-court soccer pitch and playground to make the property more attractive. And then we're completing the installation of solar screens throughout the property as well. At Solano, that's our most recent acquisition. It was from July of this year, July 15th. We scheduled about 85% of the exterior CapEx that we had planned. And the majority of the other projects were still in the bidding phase, but we've solicited 2 or 3 bids, might be waiting on a few more for a variety of other projects, mainly interior, but some additional exterior work as well. So those are both rolling. Landing should be completed this quarter. Solano, we aim to have most of the CapEx work completed fourth quarter as well. One challenge we had over the quarter, and I'm not sure if anyone else has faced this, not just in real estate, but in any other business areas, was labor. And so it's really a crux of our business. The property managers, maintenance, without the right people. If you could mute yourself. Sorry, I'm not sure if that was a question, if you want to rephrase it. Okay, moving on. But yeah, so labor, we definitely saw a shortage of workers and available staff. And so that led to higher expenses at a variety of our properties, mainly due to the prevalence of increased contracted temporary workers. So we had to reach out to temporary maintenance people and some leasing staff as well, just to make our properties run. Up to this point, as of the end of September and actually maybe the first week of October, all of our properties are now fully staffed thanks to a huge push by our VP of operations at Radiance Living, which is our property management company. That was another development in Q3. We brought property management in-house, but he spent a great deal of time and energy, not only marketing for hires, but also interviewing and extending offers. And so it was quite a big push by him. And now we're looking forward to leveraging the team that we have in place to really turn our units quicker and decrease the length of time for work orders and maintenance requests, because these are really drivers of the renewals and also referrals to our leasing process. As I said, all properties are now fully staffed, which we're thrilled about. It's a great weight, I'm sure, off of his shoulders, but off of ours as well. And lastly, cash flow. So, of course, always monitoring cash flow to pay not only our investors, but all of our accounts payable as well. Collections have been improving, specifically at the Landing and also at Solano, but we've only had it for about 2 months. So there's a little bit of noise still. But collections have been improving largely due to the continued approval of rent relief payments from a variety of sources, both federal and state. However, the timing of payments is still pretty wild and varies quite a bit. As you'll see once we get into some of the actual data and visualizations, the timing of payments has fluctuated from, we hope that we're getting most of our payments in early in the month. It's not always the case, and there is a little bit of distortion as well, particularly when we look at Solano due to the transition. Some of the payments that had been approved by when the prior owner was in possession, some of those payments were going still to them after takeover. Some of the payments were being sent by check. Some were being sent by ACH. So it was kind of a whole whirlwind that we had to track, and more specifically, the property managers had to track. But it seems now to be leveling out and stabilizing somewhat, which is great. And then our property managers had a great onus on reducing bad debt. And so the way that we've done that is not only by assisting current tenants with applications for rent relief payments, staying with them, making sure that the approvals come in. And then also as we're moving forward and expanding and changing up our tenant base, really putting a push and focus on hiring well-qualified tenants that are not going to rack up huge bad debt. But the rent relief has been a great source of reducing bad debt as well, because we're getting payments in arrears as well. So that's just a quick, very high-level summary. Now I want to jump into, so this is a dashboard with a number of different tiles that we look at on a monthly, weekly basis, both from the asset management and property management side. And this is kind of a condensed version. We have a number of other things that we look at, different metrics, KPIs, but this is basically a summarized version and just some highlights that we wanted to share with everyone. So first off, we start in financials, and you can look at, to the right side, historical trends, not only for total income, total expenses, and net operating income. As you can see, net income, this is for, you can see here first, the Landing at Pinewood Park. There's a little bit of distortion. We took over at the end of April. So May is, might maybe could just filter that out. But the trend that we want to highlight is that the total income is improving month over month. You can see in September, the last date that we have audited, finalized financials, month over month change in our actual income was up 4.5%, and the 3-month change was up 9%. So it's definitely a great direction and great move in the right direction. The two things to note there are, and we'll get into this on the next graphic, but we had about 40 plus down units that we've now have been fully renovated and have released. 6 of those units we're testing out higher end finishes to see if they'll command rent premiums as well. But on the whole, our rental income has been improving. Losses are paring back. And so while we're still under our budget, this is a third-party budget that we're using. So it is a little more conservative in some areas and aggressive in others. We're slightly below budget, but the trend is on the upswing, which is great. Moving on to total expenses. So also in the right direction, expenses are trending down. However, as I mentioned, there was quite a bit of complication or over expense from our labor and turn costs.
To the left, what time period is that for?
Sorry, is this height? So up here, the title is so Landing Pinewood Park as of 9/25. So this is a monthly P&L.
So that is for the month of September.
Correct. Yes.
Got it. Okay, cool.
So we can, we can change it around if we want to look at quarterly periods, if you want to look at, our portfolio of these 2 properties as a whole. And this is something that we definitely do. We look at our portfolio as a whole and then dig into each property individually. I was just keeping it, kind of high level now. Don't want to overload or get too into the weeds with anything there. But yes, sorry, to be clear, this is for Pinewood Park, the landing at Pinewood Park for September. So as you can see, turn costs on a quarterly basis. This is for the month, but on a quarterly basis, our turn costs were slightly higher than budgeted, as were our personnel. And again, this was a result of having to hire temporary workers to replace some turnover, not only in terms of maintenance, but also leasing. We had a great maintenance employee who actually hurt himself at Solano for whatever reason. He didn't want to go through the OSHA required tests and lost some just, consequence, I guess, of doing business, or just a rare one-off thing, but it impacted our top line. You can see insurance, we track taxes. These largely don't change. But on a whole for the month, our operating expenses came in under budget, which was great. So while there were a few categories that were over, largely we were under. And a result of the two of them, as you can see, our net operating income is trending upwards. Month over month, August, we were up 9%, and September, a big bump towards 18.1% month over month. And we expect, as we move forward and lease up the property and stabilize it, that not only will our net operating income increase, but our income as well as our gross potential rent increases, and we start to institute some rent premiums as well. If we want to just touch on Solano briefly here, again, here we've had quite high utility costs. Rental income, we've started to raise rents, which has been great. And this property, I should mention, which will come on the next slide, Solano is quite a bit higher in terms of occupancy. And again, it's due to the 40 plus down units at the landing that we brought online recently. If anybody doesn't have questions here, I can jump into the next slide, or next tile, if you will. So these are daily collections. So all three tiles here, this is again keeping at the landing at Pinewood Park. If we want to look at our portfolio, we can certainly do that. We see this is a combination of now Solano and the landing daily collections. So the landing has about 228 units. Solano is 262. So our gross potential rent at the two properties is quite different. You can see the breakdown here. And then in the tooltip, this is the August, September, October. That's the aggregation of both properties on a portfolio level. But if we keep it just simpler, so looking at the landing, because we have more data here, seeing as we took over in April. One thing that we look at is the curve or the trend of when our collections are coming in. And so two things that we're happy about looking at October, most recently the orange line. Not only was more money received or collected earlier in the month, so the first week you can see we collected higher on average than any other month, 22,000 compared to the next highest number of 15,000 in July about, but also the next week after that. So within 2 weeks, we collected, roughly 70%, 75% of the money for the month, which is great. And then in addition, the overall collections in total is trending upwards. And so that's, you can see here as well, these collections over time per month. And so we've collected more in October than any prior month. Again, so we take it with a grain of salt, and we want to go back afterwards and look into, tie out payments specifically, because as I mentioned, the rent relief payments don't always come in perfectly on the third of the month as you would hope. Sometimes they are coming in, they are lagging. And then as additional approvals are coming in, the money in arrears is coming in as well. And so sometimes these numbers could be slightly distorted. So that's one thing we go back and verify and just make sure that we're actually comparing apples to apples and not being affected by image. We actually go and delve into the data. It's something that our property manager or head of property management looks at and, make sure that we're tracking and allocating numbers accordingly. And so if you look at Solano, what I mean by that is one thing you can see here, towards the end of the month, we had a huge bump up. And so this is for August. So, one inference that we made was that's maybe that's great that that's coming in, but probably it's money that was allocated from a large chunk of approvals that just came in. And so this might not be specifically indicative of monies that were from August, but maybe were historical payments that had caught up from July. And so that's something that we went back to look at and just again, didn't let the visualization distort the actual reality of the picture. So to go back to the landing, we also track delinquency, bad debt, as I mentioned earlier. And so while our 0 to 30 bucket has been increasing and slightly consistent, that is not as worrisome because that could just be, again, maybe the monthly payments hadn't come in by that time. We're more concerned with the 30 to 60, 60 to 90, and then long-term bad debt. And as you can see, the 30 to 60 bucket upticked slightly, has come down a bit, but these are numbers that we're consistently looking at and want to track to make sure, again, our bad debt's not getting out of hand. If we have some tenants that are racking up bad debt, as many of you know, there has been an eviction moratorium. We have tried to work with all of these tenants and get them applied for and approved with rent relief payments if, we understand some people have fallen on hard times or there have been issues COVID related. But if there are people that certainly simply aren't willing to work with us, then we have filed eviction proceedings, and some of those are starting to go through now as time progresses. So after we've looked at the financial picture, we also want to see just the overall picture in terms of occupancy at the properties to see if our collections are going to have the possibility to increase. And so looking at this is for the landing, occupancy historical. So it looks like it's quite a bad or dire picture at this point, if you will. But so underlying this is the fact that, again, as I mentioned, we had about 40 down units come online. And so essentially what's happened, occupancy hasn't dropped, roughly 5% in a month. The denominator changed because we added additional units to our overall property. So this is really the effective rent. If we were excluding units, which we had been, the numbers would be different. However, that said, we do acknowledge that this is below where we want to be, 77.1% overall. And so we have a really big push, both in terms of online marketing, guerrilla marketing, social media, to increase the property's occupancy, to really lease up by the end of the year. And stabilize the property. That's our number one goal here as we wrap up CapEx at the property. If we look to occupancy by unit type, we can see that our 1-bedrooms are lagging. Kind of a symptom of just the overall market there. A lot of the tenants in this market, and specifically that are attracted to our property, are families. And so they're interested in larger units. 1-bedrooms, as you can see, they are lagging behind. But if we look at for total occupancy, well, the numbers have dipped again effectively. What we're concerned about, or what we're looking at, and what is a positive note over the quarter, are the number of overall move-ins. So we had 9 in July, and you can see the breakdown by 1, 2, and 3 bedroom. Again, the majority are going to 2 bedrooms. Maybe they don't need as much space, but they still, tenants need a larger size than just 1 bedroom. 9 move-ins in July, 15 in August, and another 9 in September. So positive trend there. People are attracted to the property. People are moving in. This is largely a result of the denominator changing, but also we've had some delinquency and some skips, evictions as well. It's something that we anticipated though. And so what we're happy about is the overall trend in move-ins. People are moving in, and these are higher quality tenants that are not carrying bad debt. And so we're turning around the tenant base at the property, which is a great sign here. Again, 2 bedrooms continue to outperform 1 bedrooms. If we look at Solano, there are a number of different unit types. So it gets a little bit overwhelming when I change this. We would filter this down and look at specific unit types. You can see here as well, the properties stabilizing. These were move outs that were already scheduled in place. And as we run through our CapEx and really improve both the interiors and exterior of the property, we believe that not only will occupancy increase, but also we'll be able to garner bumps in our rents as well and increase our gross potential rent. So one thing that we were looking at is between the 2 different 2 bedrooms here, you can see the 2x2s are fully occupied. Every unit is taken. Whereas the slightly larger 2x2G unit, so the 2x2E is about 1,000 square feet, where the 2x2G is 1,100. So that's lagged behind. There have been quite a few move outs. We want to go back and look at, maybe are those units older and worse shape than the other units? Are people simply not wanting that extra 1,000 square feet? But just diving in deeper into this data to see how can we bump up the 2x2G units, which are pretty similar, not exactly, but how can we basically bridge that delta there? And is there something grossly different between these 2 otherwise quite similar 2x2s? So after we've looked at that, the price difference, if we go to the next slide, I believe it's, well, let me just give you actual data then guessing. So if we're looking at these 2, so the difference is about only about $40 or so for the month of October. If we look at the month over month, so we've raised rents on the G unit, the slightly larger G unit, by about 0.8%, and the E units roughly are unchanged. So it could be that perhaps the slight bump in rent, maybe the tenants that were in those units couldn't sustain that increase, or they wanted to leave, they wanted to go to a different property. But that's something that we would for sure follow up with the property management team and see in our exit surveys, why did the tenants that were in the G units leave? Was it something that, maybe they had a bad experience at the property, could have been, or they just wanted to go to a different area? We would dive further into the data to see why that change actually happened. But yeah, staying on this tab here. So if we look at, going back to the landing. So if we look at the property as a whole, and we look at month over month change, we can see that on average across all property types between September and October, we raised rents about 0.9%. So slight increase. Again, this is will be increasing quite a bit more as the remainder of these units are coming online and start to be rented out. This graphic here, I should note, is only looking at currently occupied units. So this is not on a total property level. We can filter that as well if we want to see, for the overall rent for every 228 units within the property. But this is looking at specifically just our current actual rents. And so if we see, looking at the individual types, and move this down. So this is I'm showing this through Microsoft Teams. It's using a Power BI plugin, and so some of the functionality might not come through. I don't think it is. But in Power BI, you can drill down into different levels and such. But anyway, so the point that I was going to say is our one beds have been roughly in line. They on average increased about $2. September increased. October for 2 bedrooms increased about $7 per unit, and our 3 beds are pretty much in line as well. But so we track, where are we getting the bumps as far as which units specifically, and then how do we get up to the market rent? So currently, all of our units and for the property as a whole are below the market rent. But as we release these new units and we're going to start increasing the rent amounts for these new upgraded units and for the upgraded property, we're going to close this delta as well, and we'll come up to market rents here. Very similar at Solano. You can see that our current rents are almost in line with the market, and we continue to raise our rents here as well. And as we continue to roll through our CapEx work, we believe that we'll be able to command a premium to the market here as well. So this is, it might look very busy. I didn't want to overload too much data visualization here, but just to show you, this is something that the property management team looks at quite a bit. We look at as well in terms of leases and conversion rates for our property manager and leasing staff. But if we start at the top, this is an image or a visualization of exactly where all of our leads are coming from. And so 2 things to note here. It looks like we had, huge drop off and that the interest in the property is just dried up at the end of August, which is not true. So we started Radiance Living at the end of August. We actually rolled it out September 1st. And so some of the data from these 2 sources, apartments.com and apartments 24/7, the transition still just recently occurred. And so the data has lagged a bit behind. So this will get updated and we'll see these numbers as well. So it's nothing to, worry about at this point. It's simply a symptom of the transition. But something that's interesting and that is great to see is this brown box here, which has consistently grown. So this is specifically resident referrals. And so it's 19% of the total here. Looking, comparing it to the total is not going to be accurate here because we have another of leads that aren't actually shown here. But the overall number of resident referrals is high and continues to grow. And that's something that speaks volumes to not only the staff at the property, but the property itself. Simply put, a tenant's not going to refer somebody to their property unless they're happy living there. So hopefully they've had good experiences with not only the maintenance, but the property as a whole, and they're continuing and expanding their referrals to family members, friends, etc. So this we're excited about and hopeful that it's going to drive new leases and new move-ins as well. To track our leasing staff and to make sure that we're really continuing to perform and stabilize and lease up the property, we track not only number of showings, number of applications that come from them, and then ultimately the number of leases. And then we also tie this into prior slide or tile that I showed. Ultimately, the number of move-ins. That's what we mostly care about. Some of these leases might not go through, but this is the number of net leases. So not just the number of overall leases that have been extended, but the number of actual leases that went through that weren't canceled, denied, etc. And as you can see, overall, we've been relatively in line. October was a slight dip as we're going into now the winter season, and less overall moving, less move-ins. But it's something that we're tracking, and we're speaking with the leasing staff to determine how other methods of both marketing and then retention can we track and can we target to increase our leases and push to this slower time. I'm sure many of you know the summer is when the majority of the move-ins happen. And as you can see, the numbers are obviously increasing there and dropped off a little bit. But, going forward, we are confident that we can hit new leases. And then we also track our renewals as well. And so you can see our renewal percentage has grown quite a bit. I mean, there were less expiring leases in September, but we want to consistently try and be above, as high as we can be, but, definitely be above 50, 60%. We want to track also why people are leaving, as I mentioned. And then one other thing is just to look again, see any outliers that are existing. So we would look at, these renewals, the time periods might be slightly off. Maybe some of these expired leases or renewals came in after the month. So we'd want to go back and look at, this specific month and see were some of these renewals from a prior period. But again, that's something that our property manager uses more, on a much more weekly basis to track and motivate leasing staff as well. But so moving forward, Q4, we look to really continue the progress that we've made and only build on. We've got a lot of exciting things happening. So more on Rob and Charles Waldron's front, who are closer tied to acquisitions, dispositions. We have one of our properties currently under contract. And that is for, well, actually I'm getting confusing this. So in terms of our acquisitions, we have a property currently, it's about 160 units that's closing this month, actually the next probably 2 days or so. We are hoping, and that's going to be a great addition. It's a really high quality property split over 2 separate, basically split in between a road. And then we're also under contract for 528 additional units. These are split between 2 different properties. One is a 2000 vintage. The other is, I want to say 1970. Yeah. No, okay. Thanks, Rob. Yep. 1970.
All 3 deals in Houston, which is great.
Yeah. So we'll hopefully be able to capitalize on some synergies from the areas and relating to our other properties. And then dispositions wise, so we are currently under contract to sell our very first investment. It'll be our first full cycle investment as well. That is 261 units. And then we have our second property that is currently on the market as well. And so actually called offers will be coming in shortly for that. So we're really excited about both of those things. The market's been incredibly hot, and we feel that we've put in some great value to both these properties, but left enough meat on the bone that clearly some other groups are interested in coming in and taking it a step further. And so we're excited about disposing of those 2 assets.
And the important thing to note there as well is, those 2 sales are going to be big wins for us, and those are also 2 properties in Houston. Our management company, Radiance Living, is based in Houston. And so the disposition of those 2 assets will result in 421 units cycling out of the portfolio. But as Josh mentioned, we're closing on the 160 units next week, and then another 500 and change that we have under contract. So in the end, after we have all the deals closed that are in the pipeline, as well as selling the 2 deals, we'll still be around 1,500 units in the portfolio. So still a decently sized portfolio and enough to have scale and continue to focus on our operations, specifically in Houston.
Yeah, exactly. So other than the landing, which is in Lubbock, which is a tertiary market, maybe a 2-hour or so plane right away, hour and a half, the rest of our portfolio is concentrated in and around Houston. And so we're able to create some synergies and leverage staff at one property to another if need be. And it just makes overall property management, our VP of operations, less of a headache for him. He's not traveling to different states all over the place. He's, he has a portfolio there that's within easy reach, and he can more easily manage and create operational efficiency. Lastly, continued expansion. We're looking to expand into other markets besides just Houston. We're still very bullish on Houston. but we're looking at Dallas, Fort Worth, and a number of other markets as well, if the right opportunities present themselves. And then in terms of other integrations, so we're also looking at perhaps bringing in construction in-house, perhaps accounting in-house. And then software-wise, we're rolling out a new investment management software very shortly, and then some integrations with our property management software as well. We're looking to really make our tools and offerings very robust, not only for our tenants, but for ourselves on the corporate and property management side. So that's all I really want to share. I don't want to talk too much. I'm sure this is a blast or a ton of information to throw at everyone, but love to open it up for questions if anyone has any.
Yeah, great job on that. That was really good stuff. So if anybody has any questions, I know we've been kind of having some questions in the chat throughout. So appreciate that, and happy to answer any questions again in the chat or now live, as we don't have anything more to share with you. So we appreciate you guys joining us live. We'll be, this is recorded, so it'll be posted on YouTube at some point, and you'll get a follow-up email as well with the link to the recording, as is the case with all our webinars. So as long as you register for the webinar, you don't have to attend. You'll get the link to the recording. So again, we thank you for being here live, and if there's no further questions, we'll jump off and let you guys enjoy the rest of your day.
Yeah, so Rob, I know you responded to Justin's question here. Yeah, we do pull these directly from the property management software, and we're hopeful that in Q1, they've mentioned that they'll be connecting or have the ability for us to connect via an API. And so it'll just make the data live, imported live, and just less work on the back end. But yes, it's coming directly from property management software.
Yeah. So what you guys saw just now is the early stages of the proprietary dashboard that we're building for data visualization and drawing better insights from our portfolio. So Josh has been hard at work putting that together, and it's already looking amazing, but I think we're just getting started. So it's going to really help us on the operations side, and then it also helps on the reporting side. So something that we're going to work towards, as Josh said, with the API integration, we'll essentially have live data coming in from our properties. And our thought is to experiment with a external facing dashboard where basically investors can click a link and check out the live data across the portfolio, or maybe just the properties that they're invested in, and see the data live and check out various visualizations. So it's important not to provide too much information, just because it, like, as you can see, it can be overloading. So we'll be picking out just the exact, most insightful visualizations. And yeah, I think that's going to be really great.
Yeah, and then it's also helpful to, as I mentioned, there can be some nuances to the data, or I don't want to say disclaimers, but certain numbers that might be carrying forward from a prior period. And so like Rob said, we don't want to give too much information out there, because it might lead to questions that they might be valid questions, but without somebody taking the time or being there to explain exactly why these things are off, it might raise red flags that aren't really red flags. But just, again, you need to get into the data and truly, see where it's coming from, and not just go blindly off of software.
Right. Yeah. It's a danger to essentially create more work for ourselves. So we have to be very careful and try to avoid that if we can. So hopefully this makes everyone's lives better, easier, and not harder. So yeah, thanks again for joining us. We'll jump off, and we'll see you guys next time.
Thank you.